Hello students, welcome to the lecture on accounting for partnership firms, reconstitution and dissolution, and after this lecture we will be able to learn the following objectives. Discuss dissolution of partnership firm, describe, state the meaning of retirement, death of a partner, and explain change in the profit sharing ratio among the existing partners. Let us start with what is partnership. Partnership is a form of business organization. A business and its ownership are independent concepts. The idea that the actual business and the form of organization that owns it are different would help you in creating an understanding on the difference in accounting for partnership firms and other forms of business organizations. Reconstitution of partnership firms. Partnership is an agreement between the members of a firm for sharing the profits of the business carried on by all or any of them acting for all. Any change in this relationship amounts to reconstitution of the partnership firm. A change in the partnership agreement brings to an end the existing agreement and a new agreement comes into being. The new agreement changes the relationship between the members of the partnership firm. Hence, whenever there is a change in the partnership agreement, the firm continues, but it amounts to the reconstitution of the partnership firm. Any change in agreement of partnerships called reconstitution of partnership firm. In the following circumstances, a partnership firm may be reconstituted: change in profit, sharing ratio, admission of a partner, retirement, death of a partner, change in profit sharing ratio among the existing partners. When all the partners of a firm agree to change their profit sharing ratio, the ratio may be changed. In this case, one profit is purchasing a share of partner from another one. In other words, share of one partner may increase and share of another partner may decrease. Dissolution of a partnership firm. An existing partnership dissolves whenever the reconstitution of the existing firm is caused by admission, retirement or death of a partner. However, the dissolution of partnership does not lead to the dissolution of the firm since the two situations are different. In case of dissolution of partnership, the firm continues, only the partnership relation is reconstituted, but in case of dissolution of firm, not only partnership is dissolved, but the firm also loses its existence, implying thereby that the firm ceases to operate as a partnership firm. After dissolution of firm, the firm does not remain in business. The only business to be carried out is akin to its funeral ceremony, that is, closing ceremony of all existing activities.
Reconstitution of a partnership firm on the retirement or death of a partner. Why does Cuddle want to retire?
He is tired of working. He claims that when he joined the partnership, he didn't know that he would have to work so hard.
Well, let us ascertain the amount due to him. On the retirement or death of a partner, the existing partnership deed comes to an end, and in its place a new partnership deed needs to be framed whereby the remaining partners continue to do their business on changed terms and conditions.
So, is there any difference in the accounting treatment during retirement or in the event of death of a partner?
There is not much difference in the accounting treatment at the time of retirement or in the event of death. In both cases, we are required to determine the sum due to the retiring partner in case of retirement and to the legal representatives in case of deceased partner. After making necessary adjustments in respect of goodwill, revaluation of assets and liabilities, and transfer of accumulated profits and losses. The amount due to the retiring or deceased partner. The following amounts will be added to the retiring or deceased partner's accounts. The following amounts will be reduced to the retiring or deceased partner's accounts. You are back.
Sure, why not? I see that you guys have been busy calculating my share. Sorry boys, but I have changed my mind. I think I'll stay on. What do you mean you'll stay on? You said you wanted to leave. See, we are calculating your share. You can't change your mind. I have decided to stay on as a sleeping partner. I'll have the benefits without the hard work.
Let us move on to the next topic, in which we will discuss about change in profit sharing ratio among the existing partners. When all the partners of a firm agree to change their profit sharing ratio, the ratio may be changed. In this case, one profit is purchasing a share of partner from another one. In other words, share of one partner may increase and share of another partner may decrease. In case of change in profit sharing ratio, the gaining partner must compensate the sacrificing partner by paying the proportionate amount of goodwill. Sometimes it is decided by the existing partners to change their profit sharing ratio. This change may result in gain to a few partners and loss to others. Sacrificing ratio. Whenever there is a change in the profit sharing ratio, some partners surrender their old share in favor of some other partners. The value of surrender ratio is called sacrificing. Sacrificing ratio in partnership accounting is the ratio in which existing partners sacrifice their share of profit. This happens due to a revision in profit sharing ratio or admission of a new partner. This is calculated by deducting the new ratio from the old. When there is sacrifice, new ratio is always lower than the old. Sacrificing ratio is equal to existing ratio minus new ratio. Gaining ratio. As a result of change in profit sharing ratio, some partners gain some share of other partners' share of profit. The value of gain ratio is called gaining ratio. Gaining ratio is the opposite of sacrificing ratio. This is the ratio gained to the existing partners of a firm when they revise the profit sharing ratio or when the profit share of the deceased or retired partner is shared by the other partners. This ratio is calculated by deducting the old ratio from the new ratio. The new share will be higher than the old when there is a gain. Gaining ratio is equal to new ratio minus existing ratio. Let us now learn about accounting for revaluation of assets and reassessment of liabilities. In the event of reconstitution of the partnership firm, revaluation of assets and reassessment of liabilities may be required. Re-evaluation of assets becomes necessary because the present value of the assets may be different from their book value. For example, a piece of land when purchased is shown in the books at the purchase price, but its current market value may be higher than the amount at which it is shown in the books of account. Hence, a re-evaluation of the land on the reconstitution of the firm becomes necessary. Similarly, the firm may be having certain amount of closing stock. The market value of the closing stock may be less than its book value because of change in the demand. Hence, its value has to be lowered down. In the same manner, the liabilities of the firm may have to be reassessed. A partners who gains on account of such a change should compensate the partners who loses on account of such a gain. Distribution of reserves and accumulated profits. If at the time of admission of the new partner, any reserves, accumulated profits appear in the balance sheet, then these will be distributed among the old partners in the old ratio. Any accumulated profit or reserve appearing in the balance sheet at the time of admission of a new partner is credited in the existing partner's capital account in existing profit sharing ratio. If there is any loss, the same will be debited to the existing partner in the existing ratio. Admission of a partner. A new partner can be admitted only with the consent of all the existing partners. A new partner is not liable for any profit or loss occurred before his admission. Such a partner is called a new partner or incoming partner. An existing partnership firm may take up expansion, diversification of the business. In that case, it may need managerial help or additional capital. An option before the partnership firm is to admit partners when a partner is admitted to the existing partnership firm. It is called admission of a partner. When a new partner is admitted in a running business due to the requirement of more capital, or maybe to take advantage of the experience and competence of the newly admitted partner, or any other reason, it is called admission of a partner in partnership firm. The purpose for admitting a new partner may be for additional capital, for progress of the firm, for acquiring additional managerial skill, for reducing competition, etc. When a new partner is admitted, there is a need to find out the new profit sharing ratio in which the future profits will be shared. Treatment for goodwill. The term goodwill is generally used to denote the benefit arising from connections and reputation. Goodwill means the good name or the reputation earned by a firm through the hard work and honesty of its owners. At the time of admission of a partner, treatment of goodwill is necessary to compensate the old partners for their sacrifice. The incoming partner must compensate the existing partners because he is going to acquire the right to share future profits, and this share is sacrificed by old partners. The factors that affect the value of goodwill are: business is located at a suitable place, it will attract more customers. Then goodwill increases. If the business is run by experienced persons, its profits will be also increased, and then goodwill also increases. An older business is better known to its customers, therefore it is likely to have more goodwill. If the nature of goods is daily use, the values of goodwill increase. If the firm holds license, it is difficult to enter other firms. The value of goodwill increases. If more risk is involved in business, then the value of goodwill is less. If the profit of a business increasing continuously, the value of goodwill will also be more, and if profits are declining, the value of goodwill will be less. The possibility of competition reduces, the value of goodwill increases. Some adjustments are to be made at the time of reconstitution of firm, that is, treatment for re-evaluation of assets and liabilities. The assets and liabilities of the firm are revalued, and the profit or loss resulting from the revaluation is transferred to the capital accounts of all the partners in their old ratio. The actual value of the assets and liabilities may be different from their book value as shown by the balance sheet. So re-evaluation account is prepared at the time of admission of a new partner to record any increase, decrease in the value of assets and liabilities. The value of some assets may increase with time and some may show a decrease. Similarly, some liabilities may also show increase, decrease in the value. The re-evaluation account is credited if there is an increase in the value of assets or decrease in the value of liabilities. On the other hand, it is debited if there is any decrease in the value of assets or an increase in the value of liabilities. This account is a nominal account and is sometimes also called profit and loss adjustment account. The profit or loss arising due to re-evaluation is divided among the old partners in their old ratio. Adjustment of accumulated profits and reserves. All the balances of accumulated reserves, funds and undistributed amount of profit or loss appearing in the balance sheet of the firm on the date of retirement death is distributed amongst all partners, including retiring deceased partner in their old profit sharing ratio. Let us now move ahead to discuss the calculation of deceased partner's share of profit till the date of death. After retirement of a partner, the remaining partners may decide to adjust their capital. Often, the remaining partners determine the total amount of capital of the reconstituted firm and decide to keep their respective capital accounts in proportion to the new profit sharing ratio. The total capital of the firm may be more or less than the total of their capital at the time of retirement. The new capitals of the partners are compared with the balance standing to the credit of respective partners' capital account. If there is a surplus in the capital account, the amount is withdrawn by the concerned partner. The partner brings cash in case the balance in the capital account is less than the calculated amount. Dissolution of a partnership firm. The dissolution of a firm implies the discontinuance of the partnership business and separation of economic relation between the partners. In the case of a dissolution of a firm, the firm closes its business altogether and realizes all its assets and settles all liabilities. The payment is made to the creditors, first out of profits and assets realized, next out of the contributions made by the partners in their profit-sharing ratio. When the final payment is made to the partners for their due share, the books of the firm are closed. Dissolution of the firm is different from dissolution of partnership. As per Indian Partnership Act 1932, dissolution of firm means termination of partnership among all the partners of the firm. When a firm is dissolved, the business of the firm terminates, all the assets of the firm are disposed of, and all outsiders' liabilities and partners' loan and partners' capitals are paid.
Dissolution of a partnership and dissolution of a partnership firm. Stop arguing, both of you. All right, Gadbad. I shall try to clear your doubts. What is meant by dissolution? According to Section 39 of the Partnership Act 1932, the dissolution of partnership between all partners of a firm is called the dissolution of the firm. That means the Act recognizes the difference in the breaking of relationship between all the partners of a firm and between some of the partners. And it is the breaking or discontinuance of relationship between all the partners which is termed as the dissolution of partnership firm. The dissolution of a partnership may take place in any of the following ways. Change in existing profit-sharing ratio among partners. Admission of a new partner. Retirement of a partner. Death of a partner. Insolvency of a partner. Completion of the venture, if partnership is formed for that. Expiry of the period of partnership, if partnership is for a specific period of time.
Types of dissolution of firms. What are the ways to dissolve a firm? A partnership firm can be dissolved in two ways. Without the intervention of the court, when all partners agree to dissolve the firm. Compulsory dissolution, when all or all but one partner of the firm becomes insolvent, when business of the firm becomes unlawful, on the happening of any of the following events: on the insolvency of a partner, on the fulfillment of the objective of the firm for which the firm was formed, on the expiry of the term period for which the firm was formed. By notice, when the duration of the partnership firm is not fixed and it is at will of the partners, any partner, by giving notice to other partners, can dissolve the firm. Dissolution by order of the court. A court, on application by a partner, may order the dissolution of the firm under the following circumstances: when a partner has become of unsound mind, when a partner has become permanently incapable of performing his duties as a partner, when a partner is found guilty of misconduct that may harm the partnership, when a partner consistently and deliberately commits breach of partnership agreement, when a partner transfers whole of his interest in the business firm to a third party without the consent of existing partners, when the court is satisfied that the partnership firm cannot be carried on except at a loss. When the court finds that the dissolution of firm is justified and equitable. Settlement of accounts. In case of dissolution of firm, the firm ceases to conduct business and has to settle its accounts. For this purpose, it disposes of all its assets for making payment to all the claimants against it. Partnership Act provides the following rules for the settlement of accounts between the partners. Loss to be paid first out of profits, next out of capital, and lastly by the partners individually in the proportion in which they were entitled to share the profits. In other words, losses are to be shared by the partners in their profit-sharing ratio. Assets of the firm are first to be applied in paying off the debts of the firm to the third party, next in paying off to each partner proportionately what is due to him from the firm for advances as distinguished from capital, and the residue to be divided among the partners in the proportion in which they were entitled to share profits. Preparation of realization account and other related accounts. The books of accounts are closed and profit or loss on realizing the assets and discharge of liabilities has to be computed in the event of dissolution of the firm. For this purpose, a realization account is prepared for recording the realization of assets and payment of liabilities. Sale of assets is recorded at the realized value and payment to creditors is recorded at the settlement value. Preparation of memorandum balance sheet. If a balance sheet on the date of dissolution is not given in the question, then it is always advisable to prepare memorandum balance sheet on the date of dissolution to ascertain the amount of balancing figure. Summary. Now in the end, let us summarize what we have learned in this lecture. Partnership is an agreement between the members of a firm for sharing the profits of the business carried on by all or any of them acting for all. Any change in this relationship amounts to reconstitution of the partnership firm. An existing partnership dissolves whenever the reconstitution of the existing firm is caused by admission, retirement, or death of a partner. Sacrificing ratio in partnership accounting is the ratio in which existing partners sacrifice their share of profit. Gaining ratio is the opposite of sacrificing ratio. This is the ratio gained to the existing partners of a firm when they revise the profit sharing ratio or when the profit share of the deceased or retired partner is shared by the other partners. A new partner can be admitted only with the consent of all the existing partners. A new partner is not liable for any profit or loss occurred before his admission. Factors affecting goodwill are location of business, experienced owners, older business, nature of product, license of the firm, risk involved, amount of profits, possibility of competition. The dissolution of a firm implies the discontinuance of the partnership business and separation of economic relation between the partners. Types of dissolutions of firm are without the intervention of the court, dissolution by order of the court,